Well, hi there. Welcome to this Money Control live stream. I am Nandita Khelka. So, retail inflation, well, that has topped that 7% mark once again after hitting a 5 month low of 6.7% in the month of July. Well, till now, we were expecting the RBI to go a little slow on interest rate hikes after its previous rate hike of 50 basis points. But now, after the recent data that has come out yesterday, it looks like RBI has no choice but to go ahead with more rate hikes in the coming months. So this time around, September 28th is when MPC is meeting. Looks like RBI will be again going ahead with a 50 or 35 basis point rate hike. Now, to put things into perspective and to kind of lay down the impact of another rate hike on the common man, well, I'm joined by my colleague Dinesh Unnikrishnan. Hi, thanks a lot for joining us, Dinesh. Tell me, it's almost certain that inflation will continue to hover above the 6% mark for September as well. And once that happens, it will mark the third straight quarter of inflation reaching the RBI's tolerance band of 2 to 6%. And if that happens, RBI would have failed to meet its mandate on inflation. So, what will the RBI do once it fails to meet its mandate on inflation?
Hey Nikita, thank you for inviting me to this show. I think you have pretty much summed up the entire inflation scenario very well. I think the RBI is paying the price for waiting too long to counter the inflationary impact. If you have seen the last 1 or 2 years post the pandemic, the central bank and the MPC at a broader level was seized with the idea of bringing the growth back to the recovery path. In that process, probably they left the inflation ignored for too long, and the whole focus was on growth recovery. And at some point, when the external factors, the global factors, the situation in Europe and higher commodity prices, etc., spilled over to the domestic economy, things went out of hand, and inflation, you know, started moving to the 7% or 7% plus. So I think we have all of us have been discussing this scenario for too long that RBI or the MPC rather RBI is now a part of the Monetary Policy Committee, which also have the external members. MPC will have to, for the first time since 2016, when MPC was formed, they will have to admit failure on their primary mandate, which is keeping the price stability under check or inflation. So, what can RBI do now, or what can MPC do now? Going by the rule book, they will have to uh, write a formal letter to the parliament, to the government, explaining the reasons of failure, why as you know, the inflation mandate given to MPC is to keep inflation between 2 to 6% band with a medium-term target of 4%. So quite clearly, for 3 quarters, this has gone far above the 6% level. They will have to explain to the government why the failure happened. They will have to also give a detailed plan of action to bring inflation back to the 4% level or at least the 2 to 6% target. So these are the things expected from the RBI now. Uh, I suppose they will meet soon and prepare MPC will have to prepare a plan of action to submit to the government by end of September.
Okay, end of December, you said.
No, end of September because
End of September.
yeah,
My bad.
because the inflation number that came yesterday is for August. Now,
Right.
once the September inflation number is not really surprising downside, I believe it will average above 6%, which will mean that the breach of upper band for the
Yeah.
third consecutive quarter, which will complete that 3 quarter rule. 3 quarters will then get completed with average inflation above 6%. So I suppose by end of this month or even before that, MPC will have to meet or find out a plan to explain to the government.
Right. The general sentiment was that RBI may slow down after we saw the inflation data for the last 3 months, which had come down to a 5 month low. And economists were somewhere of the view that the RBI may actually look at slowing down a bit. But going forward, do you expect a 50 basis point rate hike once again in the September meeting?
I think you made a very important point, Nikita. Basically, they were expecting inflation to continue the easing path this month. But what really happened was the food items, the food played the villain in August. The higher inflation happened primarily because of the almost 7.6% jump in the food items. When we say food items, it's mostly the vegetables, the cereals, the pulses, etc. So there are two reasons why the food prices have gone up. One is this sporadic faulty monsoon, unequal distribution over different geographies, and the second part is the low seeding, low level of seeding. So these things are likely to put pressure on food prices again, and inflation also, there is a base effect that is playing out. Base effect means on a lower base last year, inflation numbers will show on a higher jump this
Yes.
year. So next 3 months also inflation will stay high, also because of the base effect. Coming to your question, yes, I think it's pretty much a no-brainer now to say that RBI will have to go for a rate hike. I believe anything between 35 basis point to 50 basis point can be expected this month itself, when the MPC is meeting, as you said, 28 to 30 is the next MPC meeting.
So, Dinesh, where do you see interest rates by the end of the current fiscal? And with another rate hike coming, what would it mean for the common man?
Well, it's hard to predict the trajectory of interest rates, Nikita, to be, for anybody. But I would say that rates are likely to go up by another 50 to 75 BPS this year, uh, on a conservative basis. Because of the reasons we explained, the interest rates will have to jump up because, you know, unfortunate part is that the RBI has only two tools to control inflation. It doesn't have control over the other areas. The two tools RBI has, one is the interest rates and the other is the liquidity. So the how does RBI control inflation? That's a very interesting question. Either RBI can increase rate of interest, which then banks will pass on to the end consumer. So when interest rates goes up to the end consumer, like you and me, we tend to borrow less because nobody wants to take a costlier loan. So the demand for goods and services goes down. That is how interest rate plays against inflation. Second is the liquidity. RBI, with its varied tools, can suck out liquidity from the system or keep the liquidity on a tighter mode, which will again increase the efficacy of the policy actions. But the scenario right now is that much of the inflationary pressure that we are seeing on CPI is emerging from global markets. So
Yeah.
RBI has,
Imported inflation, you say.
yeah, it's very tough for the local policy makers to get a hold on inflation so quickly because you have a war playing out in Ukraine. You have interest rates going up in all major markets, particularly in US. You
But
have
interestingly,
commodity.
food prices have come down.
Yeah, but it's too. See, these things come with a lag, Nikita. When it doesn't translate into inflation numbers very fast. So when you say the cooling down of commodity prices has happened very recently, so it might take time to take that effect to local inflation numbers. So right now what we are seeing is a lag of what happened in the recent months. So in how long interest rates will go up? I suspect that interest rates should go by, like I said, 50 to 75 BPS uh, by end of this year.
Mm.
And beyond that, all depends on how inflation is playing out. Nobody is an expert on predicting inflation. Not even the Reserve Bank of India. It has gone terribly wrong in the past when it comes to the inflation prediction. And your second question, how will it impact common man? That's the most pressing matter that one need to discuss today. Inflation is the biggest enemy in an economy. It's quite surprising that people uh, don't attribute much attention to the inflation figures, considering it as just another macro number. When inflation goes up, the prices of goods and services goes up, and that this impacts the ability of the households, particularly the those at the bottom of the pyramid, the poorest of the society, to buy more food, textile clothings, or even visit hotels, or go to a cinema. So everything, all this, the way their purchasing power gets impacted will then translate into businesses. Small businesses will not have demand, then it goes to even bigger corporations. So that overall, this creates a lag in the economy. So high inflation kills demand, and even initiates a vicious cycle that will bring down the economic growth. So inflation is the biggest enemy, and
Yeah.
higher inflation will definitely is going to have visible demand on credit growth, particularly on consumer durables and individual loans, that we will see sooner than later. Overall, the economy recovery that we are witnessing might get threatened, if the high inflation stays above 7% for a considerably long time.
Right. Dinesh, out of the syllabus question, would you say that interest rate hikes will continue into the next fiscal as well?
Well, interest rates, I can tell you that this 50 up to 50 BPS hike is very certain this fiscal. Beyond that, I expect smaller quantum of rate hikes, maybe 25 BPS,
Hmm.
depending upon the trajectory of inflation. So the Reserve Bank's own estimate is that inflation will come down to 5% level by the first quarter of the next financial year. So that the movement of interest rates will then closely be linked to the trajectory of inflation. If the RBI is right on inflation cooling down to 5% by next financial year, then
Hmm.
yes, one can say interest rate would have peaked by then.
All right. Thanks a lot for that, Dinesh, to answer all our questions and to decode the impact of high inflation on consumers as well. Well, thanks a lot for joining us on this Money
Thank you.
Control live session. For more such news and updates, please stay tuned to our Money Control YouTube channel as well. Thank you.